Hey guys, today I wanted to take a look at Realty Income, or ticker symbol O, and run it through my valuation spreadsheet. And since Realty Income is a REIT, we're not going to be using Graham's model or the discounted cash flow model in our valuation. We'll be using the dividend discount model, the P to AFFO ratio, or adjusted funds from operations. We'll apply the multiples model with four or five comparable companies, and then also do the net asset valuation model, which is these two right here are used for REITs only. Now, it might look a little overwhelming looking at this spreadsheet for the first time, but we will run through it here once we take a look at Realty Income, take a deeper dive into Realty Income. So Realty Income, we all know that it is the monthly dividend paying company, as they claim on their website. They say as of June 30th, 2023, since 1994, it has had a compound annual total return of 14.2% and increased their monthly dividend 103 consecutive quarters, which comes to be about 25 years. It's been a little while, but they released their most recent earnings report August 2nd this year for the end of the second quarter, June 30th, 2023. And just to highlight here, one of the main things from their quarterly report, they invested another $3.1 billion in 710 properties under development or expansion, into an initial weighted average cash lease yield of 6.9%. And their CEO highlighted this in his statement. During the quarter, we closed on $3.1 billion in investment volume, and we continue to evaluate and expand into new geographies. So even though this is a pretty long-standing company, they are still continuing to use their cash to be able to invest and expand. Coming over to one of my favorite investing websites, Seeking Alpha, we can take a look at Realty Income. Year to date, they are down 22%, which I believe is typical for inflationary environments, to have the REIT sector underperform the market. Just taking a look at the year to date for VOO, which is the S&P 500, or standard ETF for the S&P 500, which is up 12.4%. Realty Income has been down about 22%. Just to highlight Realty Income's dividend yield, their forward, it's sitting around 6.11% based on today's current price. Back over to the spreadsheet. So to be able to run a dividend discount model, where am I getting these numbers at? Well, I'll show you back on Seeking Alpha. Over on Realty Income's dividend tab right here, dividend scorecard, all you need is the forward annual payout of $3.07 with a 5-year growth rate of 3.71%. Dividend growth is a consecutive 25 years with a fairly healthy payout ratio of 74%. Putting all that into the calculator right here, the risk-free rate is a quick Google search, 4.55% for the 10-year bond yield. And I typically put in the return of the market. I expect anywhere from an 8 to 12%. And typically I'm putting in, I'd like to see about an 8% return. If I wanted an 8% return, what is the dividend discount model expecting me to buy Realty Income for? Next up, we have the price to adjusted funds from operation, the multiples model. Now, we can do this for price to earnings for things that are not REITs, but when we are valuing a REIT, we can't use earnings, as earnings do not accurately portray the entire value of a REIT. REITs, or real estate investment trusts, have owned land and buildings, which is not included in the earnings figure. That is why we cannot use the Graham's model, as the Graham's model uses earnings per share to be able to evaluate a stock. So the adjusted funds from operation gives us a more accurate financial model to be able to model REITs. So what do we do here? We find 6 different P to AFFO ratios, and over on Seeking Alpha, I'll show you where to find that. Over on the Peers tab under Realty Income's page. We have Realty Income and then 1, 2, 3, 4, 5 different comparable companies. All of these companies are in the real estate sector, but their industry is the retail REITs. There's other REITs such as healthcare REITs and different type of REITs, but all of these REITs are in the retail REIT sector. And to be able to find the P to A FFO ratio, you come over to the Valuation tab. And on the Valuation tab, we come down here and we will use the forward P to A FFO ratio of 12.6. We do the same for all of the other peers. For SPG, the P to A FFO is 10.06. For KIM, the ratio is 14.25. For REG, the ratio is 16.86. And for FRT, the ratio is 18.23. And for NNN, the ratio is 10.85. I really like Seeking Alpha's website. It has a ton of information. If you'd like to sign up for a free trial for Seeking Alpha, you can do so in the description. Seeking Alpha has given me a link where you can sign up for a free trial. Check it out in the description. So what are we doing here with the P to AFFO ratio, the multiples model? We're taking the average of the 5 comparable companies here and dividing it by the Realty Income's P to AFFO ratio. That will give us a ratio above 1 or below 1, and then we multiply that by the price, the current price of Realty Income, and that gives us an intrinsic value based on this model of slightly above or slightly below the current price, based on how the P to AFFO ratio is against the average of its close comparable peers. But when we click go here, we'll take a look at the 3 valuation techniques for the 3 different valuation models that we did. But before we do that, let's take a look at the net asset value model, which is again a REIT only valuation model. We simply take the operating income. We find the operating income over here. We take the 12 trailing month yield, 1.479, and or that's 1.4 billion. We put 1.4 billion here, and we can play around with the operating income growth, what we expect the growth to be. We place in total debt for net asset value, and we find the total debt over on Seeking Alpha as well. Under the valuation tab again, we find that their total debt is 20.20 billion, and then we have to come to a capitalization rate. And coming down to the net asset value model, we have operating income at 1.48 billion, and we find the operating income back over on Seeking Alpha's webpage. Under the financials tab, operating income, we take the 12 trailing months, the most recent number of 1.4 billion. Next up, we determine an operating income growth, and 15% is what analysts expect. And I'll show you where I get this figure. Over on the growth tab for Realty Income, coming down to their net income, the compound annual growth rate here at the bottom of this page. So the year over year is 54%. That seems kind of high to be able to put in for our calculator. I'd like to be a little bit more conservative. So if we come here over at the 10-year over year growth over the past 10 years, it's been about 15.45%. So I'll go ahead and use conservatively 15% as my number. Coming down to total debt, we can find total debt over here on Seeking Alpha. This is why I love Seeking Alpha. There's so much value on one website where you don't have to go to multiple websites to find various different pieces of information. Down here, total debt 20.20 billion. Cap rate I chose at 4.5%, and again, this is just a little guide right here based on your years to retirement. This is by no means an exclusive or exhaustive cap rate percentage guide. I'm sure there's a bunch of articles over on Investopedia or even on Seeking Alpha that could explain capitalization rate guide, but we'll go ahead and click go here. All in all, our calculator is saying that with a margin of safety applied, Realty Income's buy price right now is at $42.13. The current price is sitting at $49.62. So let's run through these numbers here real quick. So the dividend discount model is getting us $86.10. So if we only followed the dividend discount model, it would look like Realty Income is definitely a buy based on its current price. And again, the margin of safety has not been applied yet. The margin of safety is applied for the average valuation. So that would actually make sense that the dividend discount model is giving us a high value because it's only taking into account their very high dividend payout with a fairly decent 5-year dividend growth rate. They do claim to be the monthly dividend company, so it does make sense that the dividend discount model is giving us the highest value. The P to A FFO multiples valuation model is giving us $55.33, which also makes sense. $55.33 is about $6 more than the current price. So that is telling us that the current price to AFFO ratio is slightly better than the average of its peers. So that's telling us that Realty Income is trading slightly less, which would value it slightly less than its peers, which would value it a little higher than its peers. The net asset value model is valuing Realty Income at $24.85. Now, if we change this cap rate here for anywhere from 3 to 7.5%, so let's say you are 16 years from retirement, you put in 3% for your cap rate, it now values Realty Income instead of 24, it values it at $51. Meaning, if you were to buy Realty Income today at $51, 16 years from now, you have a better chance of receiving a return than you would in 1 to 2 years. So if you do 7.5% here for the cap rate, it would drastically reduce the value of Realty Income, meaning you would not want to invest in Realty Income if you were to expect massive returns in the next 1 to 2 years. But if you fill out the calculator here and you say how many years to retirement, you say 16 years to retirement with a 3% cap rate, that gives us about $51.53. So if we move the cap rate back to our original number of 4.5%, anywhere from 11 to 15 years, and again, this is just a guide, that gives us a net asset value evaluation of $24.85. Averaging these three together, we get $55.43. Now we come down to applying appropriate margin of safety. And again, this is an estimate or just a simple guide. You can put any number you want here. So this takes into account the 5 different market cap size companies, and the calculator automatically calculates the market cap size for the ticker symbol you put in here. In Realty Income is sitting around 35 billion. So that finds us in this large range. Now, you want to be a little safer with your investments the closer you are to retirement or to withdrawing from your portfolios. And at the beginning of the video, we said we're around 10 years until retirement, 10 or 11. So we should be anywhere from 24 to 34%. I chose 34 for this calculation. Let's say we're closer to 30. That gives us a buy price of Realty Income of around $38. If we moved it closer to 20%, that gives us a buy price of $44. So it does change it pretty significantly. And it all depends on your margin of safety. So if we go back to what we had it originally at 24%, that gives us a buy price of $42 with a margin of safety applied, which is a difference of 15% higher or 15% under the current price, meaning it is slightly overvalued. Head down into the comments and let me know what you thought of this valuation video. Let me know what I should look at next. And with that, thanks for watching.